In today's special COVID-19 report, Fred Karlinsky, co-chair of Insurance Regulatory and Transactions Practice at Greenberg Traurig, sits with our own Nicole Milos for this live discussion. This would be a good time to submit a question about the hottest topic of 2020. Nicole?
Thank you, Ed, and thank you to everyone who's joining us today. As Ed mentioned, my name is Nicole, and I'm an assistant counsel at AAIS. Today, I am very excited to speak with my guest, Fred Karlinsky, about the important regulatory and policy decisions that are impacting the insurance marketplace and policyholders as we confront the new normal in the workplace, economy, and insurance industry in light of COVID-19. By way of introduction, Fred has more than 25 years of experience and is a recognized authority on national insurance regulatory and compliance issues. He has taken a leadership position in many insurance trade organizations and has led many industry-driven legislative and regulatory initiatives. Fred is a sought-after thought leader who has spoken and presented to insurance executives and governmental officials, both nationally and internationally. Fred, thank you so much for joining us today.
Thank you very much for having me today, Nicole. As you know, our firm has a strong partnership. We represent AAIS. Robin has been a friend of mine and a colleague of mine for over 25 years now. That's sort of scary, but we just enjoy working with Ed and Joan and you and the entire management team, and kudos for the great work you all have done over the years, and kudos for pulling off the inaugural virtual main event.
Thank you so much, Fred. I know we all appreciate the kind words. And you and I both know that we're going to be discussing some hot button issues today. And it's important that we remind our audience that we're here to have an academic discussion as opposed to offering legal advice. So would you like to talk about that for a moment?
Oh, for sure. I mean, disclaimers are a big deal these days. COVID-19 is a huge issue out there. There are huge questions, huge unknowns. So what we're talking about today is strictly academic, if you will. I wouldn't be a good lawyer if I didn't have a disclaimer. Nothing that we're going to talk about today constitutes legal advice or my firm's opinion. These are solely just discussion points. If you need a legal opinion or you need legal advice, you should seek that internally or through us. And a lot of the AAS companies or clients of ours, a lot of the sponsors are as well. But anything we're going to talk about today is much more of a general nature and should not be considered legal advice.
Fantastic. With that said, let's dive in. There's many in the industry that have taken the position that commercial and business owners' policies never intended to cover pandemic risks. And in fact, that the policies were not even rated to take pandemic risks into account. What are your thoughts on those issues?
So I think that's right. I mean, I think that's a big point of discussion and a big point of contention right now. You know, much like after natural disasters, which are pretty common, tornadoes, hurricanes, earthquakes, the wildfires that we've dealt with, people are scared. They're looking for resources to help weather whatever the storm might be. Insurers do have a duty to their policyholders. Obviously, they have a duty of good faith, and they also have a fiduciary duty to their investors as well to manage the company. And if you think about it, frankly, that duty extends to the policyholders as well, because the worst thing that could happen is a company that goes out of business, right? And one of the quickest ways to go out of business is by covering things that and paying for things that aren't covered. So, for example, business interruption, like other coverages, is based on a policyholder specific policy. So if there's language in a policy that says it covers business interruption, it probably covers business interruption. But if there's not language in there where it says it covers business interruption, then that coverage is not in place. So for example, as many of you have heard already, the All England Lawn Tennis Club, otherwise more affectionately known as the home of Wimbledon, which I've been to. If you've never been to, it's a great event. You should go. But unfortunately, none of us are going this year because of COVID-19. But one of the things that is happening there is the All England Lawn and Tennis Club, which is a very exclusive club to get into. By the way, even I can't get into the club per se. I can get into Wimbledon, but not the club. But for the last 17 years, they have purchased insurance, business interruption insurance, that would cover a pandemic event. And so people were probably wondering, what the heck are these guys doing for the last 17 years? Well, guess what? This year, and again, this has been widely reported, to the tune of $140 million, that coverage is going to pay out. So it was probably worth every dime they spent over the course of time. And so there's going to be a $140 million payout to cover the losses that the All England Lawn and Tennis Club is going to suffer because of Wimbledon's cancellation. Other entities opted not to buy pandemic coverage. I'm sure in a lot of cases, especially on the surplus line side, there was probably an offer. People made a business decision. They made a business decision that, hey, this is so remote, we're just not going to pay for this coverage. We're just not going to do this. And so it's not covered. Regardless of current coverage, business interruption coverage for pandemics will likely be considered far more commercial in the future. More commercial entities will say, we want to buy this coverage. We'll see this issue to continue to evolve for a very long time to come. The requirements for physical damage to trigger coverage and exclusions related to pandemics and actions by civil authorities will continue to be debated for a long time, well past this when this pandemic is over. Insurance contracts and products will have to be evaluated really in detail and on a case-by-case basis to determine the appropriate response to what we've seen during COVID. There will be responses by insurers and regulators and insureds and courts on this issue in legislatures for a long time to come. So stay tuned. But the bottom line is most of the contracts that are out there did not specifically include pandemic, may have excluded it in some cases, and in large part, unless you did what the folks at Wimbledon did, which is buy this specific policy, it wouldn't be covered.
That's great insight, Fred. I know I appreciate the Wimbledon comments, but more importantly, your analogy to the natural disasters, because that's something that we are consistently hearing. Changing gears slightly, there's been substantial discussions at the state and federal levels to address business interruption coverage, and there have been certain proposals that have sought to apply business interruption coverage retroactively, regardless of whatever the policy language actually says or the constitutionality of the argument. Can you speak to those issues for a few moments?
So legislatures and others are loath to do things retroactively, and for good reason, because if you think about it, then you're in a position where it's really tough to rely on the law. And we're a country based on rule of law, and a number of countries are based on the rule of law. And so legislatures, whether it's at the state level or at the federal level, the United States Congress and the United States Senate, really do not typically pass things retroactively. I mean, there may be something like a tax bill, say, for example, that's passed retroactively to January 1st when taxes aren't due till April. So things like that could happen. But in this particular case, where you're basically bootstrapping liability onto the backs of insurers, I don't think that will happen. Plus, you've got another big issue out there, and that's the United States Constitution, as well as many state constitutions, which have an impairment to contracts clause. And what that means is that the legislature can impair a contract by any action that they take. So to be clear, if a contract is in place, they can't change the terms of that by legislative mandate or fiat. Going forward, it's a totally different story. If the legislature at the state levels or the United States Congress and Senate decide that going forward, insurance contracts and let's face it, the feds typically don't get into this particular area, but assume they did, for example, if they said going forward, this is what's going to happen, that's a totally different ballgame. That's something that is anticipated. That's something that is not constitutionally barred. That's in fact what legislatures are supposed to do. They're supposed to make changes when appropriate, but in the bulk of those cases, those changes are not retroactive. They're prospective changes, which is a whole different ballgame. And if you think about it, if you're in the insurance world, that certainty is so important, because as I tell my law students at FSU Law, I teach a course there. Robin's spoken at it a few times, but we teach a course. It's an adjunct professor course. I'm an adjunct professor of law there. We usually have 80 to 90 students in the course. They do it over spring break. It is the largest course at FSU Law. And what I start out with is talking to them about how insurance is unique, how insurance is different than any other product. And certainly on the pricing side, I mean, think about it. There is no other product I'm aware of where you don't know the cost of the goods sold when you ultimately price that product. And if retroactivity is a reality on this cover, or in fact for any other cover as it relates to an insurance policy, I think you're really putting the ability to have commercial insurance in significant peril, because you'll never know. The pricing is always somewhat wrong. I joke about actuaries, who I love, and say there's one thing I know about actuaries: they're always wrong. You know, no offense meant to anyone, certainly, and hopefully no taken, but none taken. I've got plenty of lawyer jokes too, but the bottom line is that would make the pricing so much more uncertain.
If I've heard you say it once, I've heard you say 1,000 times that the sanctity of a contract is the cornerstone of our economy, and I can't agree with you more. Now, another argument that's grabbed headlines involves the industry's surplus. Can you take a few minutes and address the $800 billion surplus and the argument that the insurance industry is financially capable of providing coverage for these COVID-19 business interruption claims?
Absolutely. So obviously $800 billion is a lot of money, but insurance companies don't typically pay for claims for losses that they didn't collect premiums for, or that were not subject to the terms of their negotiation or their insurance contracts. So those are the basic tenets of the insurance business. So while $800 billion is a lot of money, if you think about it, you look at the way the world works now, and $800 billion may be a lot of money, but that's made up of a lot of much smaller components. You've got companies, you've got some states where you can write insurance business for $5, $10, $20 million. And the fact of the matter is those companies do not have the kind of surplus, do not have excess surplus to pay for losses that were not anticipated, not bargained for, and certainly not priced for. And so in addition to just the inherent risk that you have to companies' balance sheets, I could see regulators having all sorts of issues with this type of scenario. I could see the rating agencies having all sorts of issues with requiring insurance companies to pay for things that they didn't plan on covering, that they didn't rate for. And it will, in my opinion, create insolvencies. You know, I've seen numbers of 150 billion a month in BI potential claims. Well, you do the math on that to $800 billion. That's like 5 months or so of the industry being able to pay those until their surplus is completely depleted. And then you get to the point where it becomes almost like a vicious cycle or a self-fulfilling prophecy, right? If you do pay these claims, your surplus goes down, you can write less, the market's constrained, and so on and so on and so on. So I think to require companies to pay for coverages that were not contemplated under their contracts becomes a very, very sticky situation, not only for insurers, not only for regulators or rating agencies, but frankly also for insurance, because you've got a lot of people that if they can't get insurance, they either can't have their business or they can't have their home. And I think that would be the worst of all scenarios.
Now, Fred, I know that you're from Florida, and I know you've made some comments with regard to the impact of the surplus on natural disasters. Would you like to take a few moments to talk about that?
Well, sure. I mean, we've seen it in Florida. You know, we have a very robust domestic marketplace in Florida, and we've seen natural disasters, frankly, and we've seen man-made disasters. We've seen mold is gold. We've seen sinkholes that were really cracks and tiles. We've lived through AOB. So I can tell you firsthand, judging from the situation that we've had in Florida, when you have perils that are either so contorted or so outside of what the realm of possibilities were when people were pricing and setting up their products that they thought they would have to cover, that has a significant adverse effect on surplus. And again, surplus is one piece of the equation, but the constraining of the marketplace, the constriction of the marketplace, and the inability for those companies to write more business, again, it increases, it spikes their expense ratio, because expense ratio is a function of how much premium you have, and it's a whole host of other maladies. So I really hope we don't get there. I think you've got a lot of well-intentioned people in Congress, and look, I'm sympathetic to everyone in the equation, and everyone should be. I think if insurers have the ability to look at a claim that's a real claim and that's covered under a policy, they should try to be helpful. And I think insurers have tried to be as helpful as possible here, but I do think there's a line in the sand when there is language in a policy or not language in a policy where something is covered or it's not covered. And so we've seen it in Florida, AOB, mold, and sinkholes / cracks really depleted a lot of the surplus of Florida carriers. And again, the ultimate person that gets hurt there is the consumer.
Great points, Fred. And your comments regarding the financial impacts of those disasters and of those extensive claims are well-founded. And it's critical for people to understand the bigger picture of the financial integrity and the impacts of that integrity on the industry.
Agreed.
Now, turning your attention for a minute to possible solutions, there's been talk about a federal backstop or a pandemic version of TRIA. And in fact, just yesterday, language was released for the Pandemic Risk Insurance Act. Can you comment on this and specifically whether you believe that this is a viable solution?
So I've done a lot of work in and around related to TRIA. I feel sort of close to TRIA, if you will. Story for another day, but a lot of folks know I was actually in the Trade Center on 9/11, 51st floor, Building 2. So I've watched every aspect of that. And obviously, as someone who deals with insurance and has for the last over 25 years, it was interesting to see how all that played out, right? So you've got a bevy of governmental programs out there as it relates to the insurance industry. You've got the Federal Crop Insurance Program. You've got the Federal Deposit Insurance Corporation. You've got a pension fund guarantee insurance company. And of course, you've got the NFIP. So there is a significant area of expertise at the federal level, and some would say there's not expertise, but I'll give it to the federal government in trying to cover areas that are potentially or in reality not allowed to be covered because of economics or other factors by the private marketplace. And so in a lot of ways, TRIA dovetailed what was out there already in terms of the federal government becoming a backstop for an area that the private market said, you know what, the losses that we might have to pay here are so speculative and potentially so large, we just don't even know how to price these. And even if we did, they could put us out of business. So the federal government coming in and setting up that backstop for TRIA was critical. It was critical for large events, large sporting events. It was critical for us being able to live our lives the way we live it. And so there's been talk about something like that for cyber for the last couple of years. And any of these types of newer risks, if you will, or more speculative risks are really conducive to some type of a federal backstop. So as you mentioned, PRIA, the Pandemic Risk Insurance Act, there was a draft of it floated by the House of Representatives of the United States yesterday. It's a worthy concept. As I mentioned, there are certain similarities to what we already have in place in terms of risk-sharing pools. You know, states have them too in some respects. People that were impacted by acts of terrorism and pandemics are suffering loss through no fault of their own. There needs to be a lot of data that's collected and a great deal of collaboration between the industry and the government to make it happen. PRIA that's out there would establish a federal risk-sharing program for the purpose of creating BI for the outbreak of infectious disease or pandemic. The draft would require participating insurers to pay a deductible of 5% of the prior year's direct earned premium, and the federal reinsurance provided by the program would pay 95% of the losses above the insurer's deductible. Very similar to the concepts that have been floated since the beginning of TRIA and the progeny thereof. The program would be triggered by an industry aggregate of $250 million in industry losses. Participating insurers would have to make available similar to in TRIA, they would have to make available business interruption insurance that's covered for coverage of a covered health emergency, which is defined as any outbreak of infectious disease or pandemic for which an emergency is declared and certified by the HHS secretary. The draft caps of the program are $750 billion, which, we talked about the fact that the insurance industry right now has about $800 billion in aggregate surplus on the P&C side, and losses up to that amount are subject to pro rata application and allocation. So the program is very similar to what we've seen before, and it's a common sense approach. One thing I do recommend, and it's always tough to do. I mean, look, we're in a very petrolic era, and we are in a situation where red and blue don't always meet, although they look pretty good on the screen right here. The bottom line is, I think what we do need to do, and it's tougher to do, I mean, I know I'm oversimplifying things, is try to get everyone in a room. And policyholders, large businesses, are an important part of the equation too, because you want to come up with a solution that works for everyone. I don't necessarily agree that a good deal is a deal that everyone walks away from a little unhappy. And I think there's probably a way. I mean, look, if you're talking about retroactivity and things like that, or free coverage, that doesn't make any sense, and someone will walk away unhappy. But there probably is a way to do this so that the policyholders, the insurers, the reinsurers, the retrocessionaires, the agents, the others can all look at this and say, this makes sense, this is the right way to go. If we think about it, and knock on wood, in a big way, we haven't really had to trigger TRIA, but the bottom line is that system seemingly has worked because it has stabilized the commercial insurance marketplace, and it hasn't left a void where anyone felt they had a hole in their program.
Now, in addition to the PRIA possibility, there's also been discussion about the National Association of Professional Insurance Agents' creation of the COVID-19 Recovery Fund. Can you speak to that potential solution?
So the PIA National Organization is working with the coalition to urge the creation of a COVID-19 recovery fund that would cover both businesses and employees. The proposal would create a COVID-19 recovery fund within the U.S. Treasury. The fund is modeled after the September 11th Victim Compensation Fund. So again, we take a lot of similarities from what happened in September 11th or on September 11th, a lot of similarities to what TRIA and the Recovery Fund did, then the Compensation Fund for victims. The Recovery Fund would provide short-term liquidity for small businesses by creating a form that basically could be electronically filed to help businesses maintain solvency while continuing to pay their employees. The Recovery Fund would protect lost wages for employees that are unable to work because of a COVID-19 infection, because of quarantine, or because of an operational shutdown. And we've seen, and our hearts go out to everyone that can't work because of that shutdown. It's affecting every family in the United States. The fund would preserve jobs through payroll assistance for temporarily closed businesses, and it would do that for entities that continue to maintain their payroll and their employees. It would provide solvency assistance for businesses that were in danger of failing as a result of the pandemic. Obviously, what PIA has put out there is a much more immediate type of thing, a much more immediate type of solution than PRIA. PRIA, or some form of that, is a long-term solution, but what the PIA has put out there recognizes that most businesses would not have carried BI coverages, and impairing insurance contracts ultimately in the long run wouldn't help those businesses going forward. So again, similar to PRIA, similar to TRIA, similar to the other things we've done, this is a common sense approach. Whether we can get everyone on the same page or not is always another story, but it is a common sense approach.
Absolutely. And the search for solution continues on multiple platforms. I want to shift gears for a moment because I'd love to take a few minutes and talk about the impacts that you're seeing this pandemic having on the insurance industry as a whole. Would you indulge me, and can we talk about what you're seeing as being long-term impacts?
Sure. So the insurance industry, obviously, over the long course of time, has adopted and evolved, notwithstanding the fact that most people think this industry is a stodgy industry. It's not. And there's been no time more indicative of that than the present, in that we've got these regulatory sandboxes, we've got innovation labs, we've got committees at the NAIC that are looking at how to move forward on not only these types of issues, but a whole host of other issues. I mean, you think about it, just a few years ago, your ride sharing was novel. Airbnb types of vacation rentals were novel too. And the industry worked through some very important issues, because if you're riding in a car and there isn't some type of coverage, that puts you at peril. If you're staying in a house and there's not some type of coverage, it puts you at peril. So the insurance industry will take a hard look at whatever data it has, or frankly, whatever data it doesn't have, similar to the case of cyber insurance, right? But it will take a look at pandemics historically across all lines. I mean, we're seeing now, as you're seeing, that this is an issue not only in the BI world, but it's also an issue as it relates to workers' comp potentially nationally. And so new products will be developed to address pandemic risk all across various lines. We've already discussed PRIA, and that will, of course, necessitate new product filings that carve out that particular coverage if that's the direction people go. And so I think you're going to see a lot of innovation. And as we saw after private flood policies became in vogue, if you will, the need for data is going to be very, very important. And so understanding what kind of risks you're writing, understanding what the potential losses are, and understanding the dialogue about retroactivity and about BI and about other things are going to be instructive going forward. I think one of the other things that's going to be very important is the standard of care that insureds place on their places of work and their businesses and their operations. And so if you think about it, in the homeowner space, for example, you've got homeowners inspections, you look at the roof, you look at whether there's a trampoline or whether there's a pool or how the house is maintained. I think you're going to see a lot more of that as it relates to commercial insurance. And I think you're going to see a lot more of that as it relates to office buildings, as it relates to restaurants. What type of social distancing do they put in place? I mean, look, and I and everyone else that's listening in and everyone else in the world hopes we find a vaccine and a cure for this thing real quick, because no one wants to live like this. But unfortunately, it is going to be our new normal. And part of risk management is adapting to changing scenarios. And I think when people are pricing, when insurance companies, when insurance brokers are working on placing and pricing policies, you're going to naturally get a better price and a better policy if you can show that you're taking this very seriously and you're doing everything you can to mitigate the possible downside to someone getting sick in your establishment. I think that's going to be so critical going forward, and I think it's going to be something that's going to really differentiate certain types of risks from others.
I really appreciate your speaking to the opportunity this provides us for innovation, because I know I appreciate that opportunity and the challenge. And we at AAIS are excited about the new product development that the pandemic has caused us to explore. So taking the conversation a step further, I'd like to know what you believe the pandemic will cause or impact the departments of insurance to do or to act upon.
So as I mentioned earlier, the departments really have tried to get innovative and try to change with the times. And some of the problems you have is these insurance statutes are written so far long ago that they don't really take into account the present state of play. But we've checked in with a number of different state insurance departments and a number of regulators. As you know, we work on a 50-state basis, and so we've got a lot of emails for folks and phone numbers where we can get them, and we've asked people how they're addressing the pandemic. And first of all, this has put their world into a little bit of a different sort of sphere, if you will, because they're used to being together. They're used to being able to discuss things and work as a team, and they don't have that anymore. So this has been tough on them, just like it's been tough on insurers and insurance service provider type of entities. But regulators are very much cognizant of not only the insured's issues. And let's face it, their main objective as regulators is to make sure that their insureds, the policyholders, their consumers are taken care of. And so they're very cognizant of the issues that folks are facing. That's why you're seeing some of these directives. I'll call them the Be Kind directive. They're not really telling you to do anything other than to try to be respectful to people, which frankly is pretty important right now. But the insurance regulators are also, because they've been doing this for a while. If you think back to the 07-08 financial crisis, I'm pretty proud of the insurance companies for withstanding that, but I'm also pretty proud of the regulatory community for not taking their hand off the table and saying, you know what, we're hearing that, a large company is an issue, but it's not really their insurance operations that's an issue. So my point in saying that is the insurance regulators understand that they need to work with the companies in times of peril, in times of concern, and they're doing just that. Most regulators want to be as flexible and facilitative to both the consumers and their insurance company consumers, if you will, as possible, to assist those insurers in serving their policyholders. Because as I mentioned, the worst possible scenario is insurance companies that are no longer around, don't exist anymore, and therefore they can't handle the needs of their policyholders. So regulators are facing challenges and looking at the actuarial impact of COVID. We've seen a number of different auto insurers giving rate rollbacks or premium discounts or some other thing in recognition of the fact that people are driving less. There's also a view by the regulators that they need to understand the health insurance market, what the disruption of elective medical procedures or being able to go to doctors is. I mean, I look at it and talk to a bunch of people all day long. Telemedicine has probably never seen a bigger boost. How is that going to change the cost of healthcare? I mean, in some respects, you think, yeah, it'll lower the cost, but in other respects, I think there is a benefit to seeing a doctor face to face where he or she can check you out completely. So a lot of this is a change in how we operate. You're going to have to be more transparent with your medical providers. And look, a lot of people, for whatever reason, don't want to be. And so that impacts everything the insurance regulators have to do when it relates to healthcare, medical loss ratios, and things like that. I wouldn't be surprised if many regulators do not or allow supplementary filings for their insurers in their particular state to show the true financial impact of the pandemic once it becomes apparent. So you're going to see a significant rate need in some areas maybe, and you'll see less of a rate need in other areas. I do think, though, that by and large, and I'm very pleased to say this, the regulatory community has taken a very collaborative approach and collaborative view on these issues. And to this point, I think each and every state, look, you've got different constituencies and different politics in different states. You know, some of the insurance commissioners are elected, others are appointed by elected individuals, and so they're all accountable to their constituents or they're accountable to someone. And so we in the industry need to respect that, and I think by and large we do. And I think the regulators need to and do respect the fact that as insurance company executives or service providers, we need to make sure that the insurance entities that we work with, that we service, that we that basically are the lifeblood of the insurance industry are here not only today but here tomorrow to pay other claims. Because after this pandemic is it'll be a long memory for us, but when it becomes a more distant memory, there's still going to be more claims to be paid tomorrow. There's going to be claims that need to be paid in a month from now. There's going to be auto accidents, workers' comp claims, all sorts of claims, and the insurance industry has to be in a position to respond to those. And I think the regulators understand that, and frankly, I think most of the consumers do as well.
Now, those of us in the industry cannot always have our heads down. We have to be looking forward. We have to be looking to the emerging risks. We have to be preparing for what's next. And I know you do this better than most. So my question for you is, what advice do you have to the industry so that they can prepare for the next pandemic?
Well, you're giving me more than I deserve and saying I do it better than most, because if I did, I would have picked 6 numbers that were right a long time ago, and I'd be doing this from a boat somewhere in the ocean. But notwithstanding that, I think we're going to see innovation. I think we're going to see new products. I think we are going to see a host. And look, we've seen it now recently in terms of cyber coverages, right? You don't have all the data you need, and that's not a knock on anyone, by the way. You get the data from claims, you get the data from court decisions and things like that, and they haven't occurred in a new product in a new area like cyber. And so business interruption, catastrophic healthcare types of coverages are all things I think we're going to see come out of this pretty quickly. We may see new types of workers' compensation coverages based on what may or may not happen in some of these legislatures going forward, or what the regulators want to see happen going forward. You may see some type of a new type of short-term disability policy. You know, the one thing I'd say that is sort of weird, and look, if you own a restaurant or you're working in a hotel or the airlines, this comment won't resonate with you, and I apologize for that. But if you're working in an office, a lot of people, like for example, for us, we took 4,600 employees, and within a 24-hour period, we put everyone remote, and I don't think our productivity has suffered necessarily. So when you do that, you have less commuting, which means less cars on the road, less accidents. You know, for every action, there is a reaction, right? And so I think it really is an open book as to what will happen. But what I do think will happen is there's a lot of smart people in the industry. There's a lot of wealth out there that needs to be protected, but there's also a lot of wealth and a lot of dollars that need to be put to use. And I think we are going to see some significant innovation again on the catastrophic healthcare side, on the business interruption side for sure, on short-term disability and workers' comp. I think those are all areas where I could see, and even, you know, heck, on the auto side, I mean, we've seen usage-based auto for a while. Some people haven't used that because they were commuting every day. Now, I don't know if that's going to, well, I know what's going to happen. It is going to change somewhat, because I think, again, you guys have been virtual really forever, right? And so that's worked for you, and I think it's worked for a lot of other people, some people who never would have thought it would have worked for them.
I couldn't agree with you more. I think there's a lot of naysayers who never thought that a remote workforce would be efficient or would be effective, and definitely did not believe that they could be productive. And I know at AAIS, remote is what we do. And I think we've proven that we can be productive and effective. But to see the companies now that are forced to act in that manner and the positivity that's come out of it is wonderful to see. As you said, you know, the positive coming from the negative. And I know you've taken a few minutes now to talk about the products that we may see in the future, but can you take a few more moments and talk about how this pandemic may impact current products? And I'm thinking of specifically those exclusions or endorsements that are under fire: the virus or bacteria exclusion, the communicable disease exclusion, civil authority exclusion, or even the usage and application of the phrase direct physical loss or damage.
Yeah, so it's hard to say what's going to happen. Obviously, I mean, this is still pretty new, and emotions are running high, and you know, people are losing jobs and people aren't able to open their businesses. And so, look, everyone's rightfully concerned, and I think we all understand that. So it is hard to say what's going to happen. I would say that it's likely going to be on a state-by-state basis. Certain coverages may be more important in one state than they are in others. If you're no longer able to exclude a coverage, for example, risks will need to be re-rated. The consumer will need to be charged for that coverage, and there will be lawsuits on that, and it'll bring up a whole new body of case law. And so I think here's what I see happening. I see people being pretty emotional right now, and rightfully so. I think everyone's really nervous, and that's human nature. But I do think when legislatures get back in session, when courts look at these types of things, when regulators look at them as well, I think there will be certain things that naturally people will say, you know what, we never thought this was going to happen. Okay, we weren't like the folks at Wimbledon that said, we're going to buy this for 17 years and then ultimately, get a payout. But we are going to need to make sure that certain things that were excluded before are no longer excluded. Now they're included. And by the way, you're going to have to set up the right form for that. You're going to have to set up the right pricing for that, especially if it's a admitted product where they still have a commercial review of rates and forms. But either way, in order for this to work, you're going to need to make sure that things are written the right way in terms of policy and things are priced the right way in terms of rates. And so, again, I think that's going to be very, very, very state-centric, which is not necessarily a bad thing because I think each state is going to have some unique characteristics.
So your use of Wimbledon as an example is really interesting because I think it highlights those issues that you've already raised, but it also demonstrates that this type of coverage was available. And unlike the terrorism coverage through TRIA that we saw after 9/11 that was not on the market, there were options for businesses to obtain this type of coverage for business interruption if they wanted to spend the money to pay for it. The issue became, as you so correctly noted, I think most companies did not believe that the risk warranted the cost. And now people are going to have to reevaluate that cost-benefit analysis. I hope that our audience has enjoyed this as much as I have. And we do have a few minutes left, and I want to make sure that we take some time for questions from our audience. And we do have one question that I would really like to get your thoughts on. The audience member asks whether you think that event venues, easy for me to say, will see liability for opening up before there is a vaccine.
I don't think they're going to see liability in opening up before there's a vaccine because I think they're going to figure out a way, whether it's on the ticket or some other way to limit their liability, which is done anyway now. And I think they're going to put all the right safeguards in place and they're going to make sure that they're protected. Having said that, I think reputational risk, set aside financial risk, but one of the things people always need to worry about now is reputational risk. Now that we have, we're all connected, right? So we know as quickly as someone sitting there as an eyewitness what goes on in New York or what goes on in Wuhan, China, or wherever. At least we think we know what's going on in certain places. But I do think that there's going to be a lot of full disclosure. One of the things you're not going to be able to do is you're not going to be able to say you did not understand what's going on. So I don't think there's going to be a lot of sympathy to people that try to do a gotcha. If I go outside, and I've limited my going outdoors, I'm walking a lot more, which I think is good. So hopefully everyone's getting a lot more outdoor time and exercising. But I'm not going very many places because I don't know what the outcome is going to be. I have a friend, and thankfully I'm saying that in the present tense, that I have a friend, 62 years old, in great shape. He just got out of a 5.5 week stay in the hospital, 4 weeks of which was in a coma, a medically induced coma. And, he was like not 50-50, he was like 70-30. And so, or 80-20, it was bad. And the fact of the matter is, I think a lot more people have those stories. And if you don't, read the newspaper or watch the news. But, there's something called assumption of risk. And I think if you go somewhere at this stage, you're assuming the risk of something happening to you. Now, you're not assuming the risk of the building falling on you because that's not logical and that's not expected and anticipated. But in today's environment, until we have a vaccine or until there's herd immunity, I was going to say herd mentality, and there's probably some of that going on too, as usual. But until we have herd immunity or a vaccine, I mean, what's going on here. You are assuming the risk. So there's going to be a disclaimer on there. I mean, what I feel bad for, at least when you're going into a sporting event or something, you've got that ticket, they've got you, they've got that written document. What about the restaurants? And my concern is, if a bunch of restaurants are going to get sued, it's only going to take one or two of these folks to say, you know what, we can't live like this anymore. We'd rather just close up shop get rid of these jobs and not serve the public than have to deal with lawsuits. And that to me is a horrible scenario. So right now and they're talking about this in terms of the state aid. They're talking about some indemnities out there for businesses that bring people into their shops. And I think something like that is really critical. Again, it's one thing if the building falls on you, you didn't expect that. That wasn't anticipated. But right now, no matter how good some places are cleaning, we don't know enough about this virus. We do know it's highly contagious, and we do know you could be 6-12 feet away and get a whiff of it and get it. We know some people are more immune than others. So that's a long answer to a short question, but I think that's the state of play of where we are now.
Fred, I can't thank you enough for the time that you've taken to speak with me today and all of the great information that you've given to myself and our audience. I've really enjoyed this. Your insight and your comments are just invaluable. If I could ask you one last question, and I promise, even though I know every lawyer says one last question and then 6 questions later, but top of mind to myself and all of our viewers, I'm sure, is what advice do you have for folks that are in our industry to navigate this new normal?
The old joke about the person that says to the lawyer, hey, I've got 3 questions for you. Number 1, can you handle this case? Number 2, what's your rate? And then the lawyer looks at him and says, okay, what's your 3rd question? The bottom line is what advice I would give to people right now. I think if you're an insurance company or you're an insurance service provider, stay close to your regulator. I think we're doing that on behalf of the hundreds of clients we have in this space. We're making sure that regulators know what's going on with them. If they've got a problem or an innovative solution or a thought, that they're keeping close to their regulator, that they understand what the regulator's thinking. On the healthcare side, ACA filings are going to be coming up. And so that's a real moving target. I do think you need to make sure you understand. I know AAIS has resources in that regard. In terms of what's going on regulatory-wise, not specific to ACA perhaps. We have resources in that regard as to what the individual states are doing. But you really need to stay close to your regulators, and you need to really stay close to your consumers too, or your customers. You need to make sure that if they need something that you're handling. So I know AAIS has a lot of outreach, but if you're an insurance company, you're an insurance broker, you should be checking in with the insureds that you have. You should be checking in with your agents. You should be checking in with your brokers, with your reinsurers, with others, because things are moving very, very fast. And we have a saying in the legislative process, and that is, if you're not at the table, you're part of the meal. And the fact of the matter is, if you're not having these discussions, I mean, I can tell you right now, things are moving fast. We probably speak to 10 or 12 departments a day in terms of, hey, we've got this specific issue, but also what are you seeing? What's going on? And frankly, in a lot of ways, they're calling us too, because they don't have the same collaborative experiences they had before with their offices being together, with a conference room that they can all mingle in and talk through and spitball these issues. And here's the thing, if you think about it, I mean, I was speaking to the business director for one of our offices this morning. She said it was sad that she had to shut down the cafe in the office, and that's where people would meet. That's where they would sit around, sometimes too long for lunch, but they would talk through issues. And so I think that outreach by people that are in the industry that want to, number one, understand what's going on, and number two, affect change is so critical and so important.
Fred, again, thank you very much. I've heard you say it before, and I'm going to steal your closing line because it's just too good not to say. To everybody out there, be diligent, stay in constant contact with those regulators, as Fred has told you, and to everybody, great luck in this challenging times. And with that advice, I'm sending it back to you, Ed.
That was terrific, Nicole. And thank you, Fred, for being part of the virtual main event. Today, we focused heavily on the technologies shaping our industry, from insurtechs and blockchain to sensors to IoT. When we emerge from the challenges of the COVID-19 pandemic, these technologies will help transform our businesses, make them better, more efficient, and more valuable. If you missed any of our programs today featuring Vint Cerf, the father of the internet, and other leading experts from IBM, Vidati, Neos, CFM, Roost, and Greenberg Traurig, visit the VME library to watch the replay on demand. As always, I want to thank our sponsors for helping to bring this outstanding content to you. Visit the virtual marketplace for more on the value of services they deliver. Tomorrow, we'll take a look at an exciting vision for the industry based on open code and open source. We'll discuss open source models and how they may affect the modern advisory organization and the industry as a whole. AAIS leaders will open a discussion on emerging trends, and we throw a spotlight on the evolutionary changes in the farm and agribusiness. And we'll close out our COVID-19 reports with an honest discussion about the sectors hardest hit by the pandemic when AM Best's Chief Rating Officer, Stefan Holzberger, joins us live. It's not to be missed. Thanks for joining us today. I look forward to seeing you on our next edition of the virtual main event.